Beneath the soil of some of the world's poorest nations lies unimaginable wealth. Copper veins stretching for miles. Gold deposits older than recorded history. Lithium reserves quietly powering the future. On paper, these countries should be rich beyond measure. And yet, many remain trapped in debt, austerity, and fragile economies. The paradox is unsettling. How can nations sitting atop trillions of dollars in resources struggle to fund schools, hospitals, or basic infrastructure? The answer isn't hidden underground. It's written in contracts, whispered in boardrooms, and negotiated behind closed doors, often thousands of miles away from the land itself. This is not a story about illegal mining or simple corruption. It's about high-stakes negotiations where power speaks softly, numbers hide consequences, and the long-term cost is almost invisible at first. Deals that looked like salvation in the moment slowly revealed themselves as economic traps. By the time the public understood what had been signed, the wealth was already flowing outward. Investors once praised these agreements as stable and investor-friendly. Governments framed them as development milestones. Analysts nodded at the spreadsheets. But for ordinary citizens, the results felt painfully different. If stories like this fascinate you, subscribe and join us as we uncover the hidden mechanics of global finance. And tell us, what country are you watching from? Because as you'll see, this story doesn't belong to just one nation. And the warning signs may feel closer than you think. What do you think? Could this happen in your country? Long before the first excavator arrived, the most important work had already been done, quietly, methodically, and far from the mining sites themselves. In government buildings with flickering fluorescent lights and in hotel conference rooms guarded by polite security, delegations gathered around polished tables. On one side sat officials from resource-rich nations, many under pressure to deliver growth quickly. On the other were executives and lawyers representing multinational mining firms, armed with models projecting decades into the future. At the time, the numbers looked reassuring. Signature bonuses promised instant revenue. Royalties, though modest, were framed as competitive. Stability clauses were sold as necessary to attract foreign capital. Economists advising governments warned that global investors were skittish, that capital could move elsewhere overnight. Delay too long, they said, and the opportunity would vanish. In countries burdened by debt and unemployment, the logic felt impossible to resist. Yet buried deep in the contracts were assumptions that almost no one questioned. Commodity prices were modeled conservatively. Environmental liabilities were deferred. Local value creation was treated as optional. Even as pens met paper, a subtle imbalance was locked in. Journalists barely noticed. Markets reacted with polite approval. Ordinary citizens saw only headlines about historic investment, unaware that the most important concessions had already been given away. The first warning signs appeared not in protests or politics, but in spreadsheets. Analysts reviewing early production forecasts noticed something odd. Revenues were flowing, but public finances weren't improving. Export figures climbed while budget deficits barely moved. Government officials insisted patience was required. Mining, they said, was a long-term game. The benefits would come later. Inside finance ministries, quieter conversations began. Royalty rates were fixed, even as global prices surged. Tax holidays stretched longer than expected. When auditors requested clearer breakdowns of profits, responses arrived late, or not at all. None of this violated the contracts. That was the problem. Everything unfolding had already been agreed to line by line. Foreign investors, meanwhile, grew more confident. Stock prices reflected certainty, not risk. New exploration licenses were requested. Boardrooms spoke openly about jurisdictional stability. For corporations, the deals were working exactly as designed. But on the ground, communities near the mines noticed little change. Roads remained unfinished. Schools stayed overcrowded. The wealth was moving, just not in the direction people had been promised. By the time policymakers realized the leverage was gone, the drills were already turning. And undoing a signed contract they were about to learn was far harder than signing one. The moment commodity prices began to climb, global attention sharpened. Trading floors lit up with green numbers as copper, cobalt, and gold pushed past earlier forecasts. Analysts revised earnings models overnight. 4 multinational firms operating under fixed royalty agreements, the upside was sudden and immense. What had once been a calculated bet quietly became a windfall. Governments watched the same price charts with mixed emotions. Export revenues surged on paper, yet tax receipts lagged behind expectations. Finance ministers faced uncomfortable questions from journalists who noticed the disconnect. How could record exports coexist with strained public budgets? Official statements leaned on familiar language: reinvestment cycles, infrastructure timelines, future upside. But behind closed doors, concern was growing. Ordinary citizens felt the contradiction most sharply. The mines ran day and night, trucks carving new scars into the landscape, while daily life remained unchanged. Wages were stagnant. Inflation crept upward as foreign currency flowed in unevenly. Economists exchanged glances, a quiet realization spreading that this wasn't a temporary lag. The system itself was functioning as designed. As profits ballooned, corporations moved quickly to lock in advantages. Additional licenses were negotiated. Expansion phases were accelerated. Legal teams invoked stabilization clauses whenever governments hinted at revisiting terms. Any attempt to raise taxes or adjust royalties triggered warnings of arbitration in international courts, expensive, slow, and often tilted against smaller states. Foreign markets responded with confidence. Investment funds increased exposure. Mining stocks were labeled safe havens amid global uncertainty. In distant capitals, policymakers praised the host nations for being business-friendly, a phrase that carried weight in financial circles. Stability, after all, was good for markets, even when it meant stagnation elsewhere. Back home, the political temperature rose. Opposition figures accused leaders of selling the future too cheaply. Protesters gathered near mine entrances, their demands simple but powerful. If the land was rich, why weren't the people? Governments found themselves trapped between contracts they couldn't break and citizens they couldn't ignore. And as the pressure mounted, one truth became unavoidable: renegotiation would come at a cost far higher than anyone had anticipated. Years later, the accounting became impossible to ignore. Independent reports laid the numbers side by side: total resource value extracted versus public revenue received. The gap was staggering. Wealth had been created, but it had not stayed. It moved through offshore accounts, corporate structures, and foreign exchanges with mechanical precision. For policymakers, the reckoning was quiet and deeply personal. Many had acted in good faith, guided by advice that prioritized speed over leverage. Others simply underestimated how permanent temporary concessions could become. In interviews, former officials spoke carefully, their words measured, as if still negotiating with the past. Communities near the mines learned a harder lesson. When deposits began to thin and companies discussed exit timelines, the promised transformation never materialized. What remained were environmental costs, limited infrastructure, and a lingering sense of betrayal. The wealth had passed through their land like a shadow, visible, powerful, and ultimately untouchable. The broader financial world moved on. New frontiers emerged. New countries, new contracts, familiar language. Investors recalibrated portfolios, rarely looking back. But for the nations left behind, the experience reshaped how power, money, and sovereignty were understood. Economists now cite these cases as cautionary tales, reminders that natural resources are not wealth by default. They are leverage. And leverage, once surrendered, is rarely returned. The real value was never just in the minerals, but in the timing, the terms, and the courage to walk away. In the end, these negotiations revealed a quiet truth about global finance. Markets reward certainty, not fairness. Contracts remember every concession. And nations rich in resources can still find themselves poor in returns, not because the wealth wasn't there, but because it left exactly as planned. The story of these mining deals doesn't end when the last shipment leaves port. It lingers in budgets that never balance, in communities still waiting for change, and in contracts that quietly outlive the leaders who sign them. Global finance often feels distant and abstract, but its consequences are deeply human. And as new negotiations unfold across the world, the question remains unresolved. Will the next generation recognize leverage before it's gone, or only after the wealth has already moved on?